Okay, part 2 of part A of chapter 8 talks about the inventory, starts out with talking about the inventory cost flow assumptions. So regardless of whether we're talking about a perpetual or periodic system, we have to assign dollar amounts to the physical quantities of goods sold and those goods that are remaining in our ending inventory. So we need a way to help us decide which units were sold and which remain in inventory. In illustration 8.7, it's going to help us explain this. 8.7 talks about the Browning Company began 2016 with $22,000 of inventory. The cost of beginning inventory is composed of 4,000 units that were purchased for $5.50 each. And we have some transactions during 2016 shown here, the purchase transactions dated January 17th, March 22, and October 15. And we see those number of units, the unit costs, and the corresponding total cost that for the total purchases that added up to 49,500. The sales we see occurred on January 10, April 15, and November 20th, and the corresponding units totaling 6,500 units. So we'll use that data, and what we need to determine is, what is the cost of those 6,500 units that were sold? And correspondingly, what is the cost remaining of the ending inventory units? Because if we had 4,000 units in our beginning inventory and we purchased 7,000 units, that's 11,000 available. And if we sold 6,500 units, we know we're going to have 4,500 units in ending inventory. So that's what illustration 8-7a is going to show us. Here's our 4,000 beginning inventory. The 7,000 units purchased gives us our 11,000 units available. And that's going to be broken down into what was sold and what is left on hand in ending inventory. 6,500 units sold, 4,500 units are on hand in ending inventory. Now, if a periodic system is used, what is the cost of those 4,500 units in our ending inventory? We have a formula here that's going to help us to determine that. We see our beginning inventory, 4,000 units at $5.50 is $22,000. We're going to add to it our purchases, 7,000 units at various prices added up to 49,500. So we have 11,000 units and $71,500 in cost available for sale. Our two question marks are, what is the value of our ending inventory and what is the value of our cost of goods sold? We see this illustrated in 8-7b, allocating the cost of goods sold. We know it has to add up. Our ending inventory and our cost of goods sold has to add up to the 71,500 that is available. So we have various methods of which we can do this to achieve this allocation between the inventory and the cost of goods sold. The first one we'll briefly talk about is specific identification. And this method is used by companies that sell unique, expensive products, generally with low sales volumes. For example, automobiles, they have unique serial numbers called the VIN, or Vehicle Identification Number, that is stamped in the front left of the front windshield area that describes each vehicle with a unique number, so that vehicle can be tracked from Department of Motor Vehicle purposes to auto insurance companies. It provides a way of tracking that vehicle. That specific identification method, however, doesn't work for all types of products because it can be a little costly to match specific purchase price with each item sold and for each item remaining in inventory. But we need to understand that it's important to note that the actual flow of a company's inventory, how it starts from in beginning inventory all the way through its finished goods, out the door to a sale to a customer, that does not have to correspond to the cost flow that we are assuming from accounting purposes. The three most common cost flow methods that we will assume for accounting purposes are average cost, first in, first out, also known as FIFO, and last in, first out, also known as LIFO. The average cost we'll talk about first. And what it does is it applies the average unit cost to all goods sold and to all goods in ending inventory. And an average unit cost is weighted by the number of units acquired at various unit costs. To calculate that weighted average unit cost, we will take the cost of goods available for sale and divide it by the quantity available for sale. And we see how that is calculated here in illustration 8-7C. You see down below here, to get our weighted average unit cost, we're going to take that $71,500 that we had available up above and divide it by the 11,000 units that we had available as calculated up above, and get a weighted average unit cost of $6.50. In our ending inventory of 4,500 units at that $6.50 equates to $29,250 in our ending inventory. If we subtract that from the $71,500 that we had available, we get ending cost of goods sold of $42,250 for the 6,500 units that were sold. And we also could calculate the cost of goods sold by taking that 6,500 units and multiplying it by that $6.50 weighted average unit cost. We'd still get the same number, $42,250. Now, the other method here is the perpetual average cost. And here, the weighted average unit cost in this perpetual inventory system becomes a moving average unit cost. In other words, we're going to calculate a new weighted average unit cost each time additional units of inventory are purchased. And then that average is then used to cost any units sold before a next purchase is made. And we'll see this in illustration 8-7D. We see our beginning inventory at 4,000 units at $5.50 or $22,000. And we'll see that over in the balance column as well. 4,000 units at $5.50, $22,000. On January 10th, 2,000 units were sold, and they would be sold at that $5.50 unit cost. That's all we have available at this point in time. So taking 2,000 units off the prior balance of 4,000 leaves us with 2,000 units at $5.50 or $11,000. January 17th, we make a purchase of 1,000 units at $6. So when we take the $6,000, what that equates to, plus the prior balance of $11,000, we end up with $17,000 in our balance. The number of units are calculated at 2,000 units in our prior balance, plus the 1,000 units purchased is 3,000 units. And when we take the $17,000 amount in our balance and divide it by 3,000 units, we get a new weighted average cost per unit of $5.66.7 per unit. March 22nd comes along, and we purchase 3,000 units at $7 a unit, or $21,000. So our total balance in dollars is $38,000. This $21,000 plus the prior ending balance of $17,000. And our number of units are the prior balance of 3,000 units plus the 3,000 we just bought on March 22nd for 6,000 units. When we do the division here, our new weighted average unit cost is $6.33.3 a unit. April 15th, we sold 1,500 of the units that we had available at that amount, $6.33.3, or $9,500. What we have left in inventory then is 4,500 units. We had 6,000, we sold 1,500, we're left with 4,500 units at that new unit weighted average unit cost, or $28,500. October 15th comes along and we buy 3,000 more units at $7.50. That amount, $22,500, is added to our prior ending balance of $28,500 to give us $51,000 in our balance. That amount is going to be divided by the new quantity of units, or 7,500 units. We bought 3,000 units on October 15th. We add it to the 4,500 units we had prior in our balance. That makes 7,500 units. Doing the division, our new weighted average unit cost is $6.80 a unit. Our last transaction is selling 3,000 of the units we have available out of those 7,500 units. So if we sell 3,000 units at the new weighted average unit cost at $6.80, we have a cost of goods sold amount there of $20,400. What we have in ending inventory then is 7,500 units minus the 3,000 units we just sold equals 4,500 units at the same $6.80 weighted average unit cost, or $30,600. Now the periodic average cost and the periodic or in the perpetual average cost generally produce different allocations to the cost of goods sold and ending inventory, as we just evidenced here. Up above here in the periodic, the ending inventory was $29,250. Here in the perpetual, the ending inventory is $30,600. In the periodic, the cost of goods sold is $42,250. In the perpetual, the cost of goods sold is $40,900. Our next method is FIFO, or first in, first out. So the units that are sold are the first units that are acquired or purchased. By default, ending inventory consists of the most recently acquired units. And here we see a FIFO flow with our total units available of 11,000. We see 6,500 units were sold, being comprised of the 4,000 units in beginning inventory, 1,000 units from the January 17th purchase, and 1,500 units from the March 22nd purchase. There are 1,500 units remaining from that March 22nd purchase, plus the October 15th 3,000 units that make up our 4,500 units in ending inventory. In the periodic FIFO method, basically I made a note over here. What you want to do is to build your ending units of inventory by working backwards from the most recent purchases until you get the quantity counted in the physical inventory. And we have to take that physical count in order to determine that in the periodic method. It says this, excuse me, in the first sentence here, that we determine the physical quantities on hand in the periodic inventory system by taking a physical count. We'll determine the cost of goods sold to be $38,500 by subtracting the $33,000 ending inventory as shown in illustration 8-7E. Here we have our beginning inventory. We have our purchases at $49,500. The same $71,500 is available for sale. By calculating our ending inventory shown below here, our 1,500 units at $7 and our 3,000 units at $7.50, that adds up to $33,000 in ending inventory, which we subtract from what's available to get our cost of goods sold at $38,500 for the 6,500 units. The 6,500 units could be costed directly as follows. You get the same 6,500 units and $38,500 dollars from these individual layers of the beginning inventory, the January 17th purchase, and the March 22nd purchase. Now, in the perpetual FIFO, we'll get the same ending inventory and cost of goods sold amounts. It doesn't matter whether it's periodic or perpetual. And that's because the same units and costs are first in and first out. In our perpetual system, you see here, every time there is a purchase or a sale, we're going to update the inventory amounts. We see our beginning inventory here, 4,000 units, and we see that balance at $22,000 in the balance column. We sold half of those units on January 10th, so we're left in a balance column 2,000 units at $11,000. On January 17th, we purchased 1,000 units at $6, and so now in the balance column we have two layers represented by this bracket here. The first layer at $5.50, the second layer at what we just purchased at $6, and that comprises $17,000. On March 22nd, we purchased 3,000 units at $7 a unit, and now that becomes our third layer of inventory added to the prior two layers, and the total value is $38,000. Now on April 15th, we have a sale of 1,500 units. Now we are using the FIFO method, first in, first out, so those 1,500 units are going to come from that first layer of 2,000, and it will drop down to 500 units at $5.50. The second and the third layer remain the same. They did not get touched, and so that accounts to a value of $29,750. October 15th, we purchased 3,000 units at $7.50, and that becomes a fourth layer. You see in our bracket here we have 4 layers now, and that comprises $52,250. On November 20th, there was 3,000 units sold, and we have to pull from first in, first out, so the first layer, 500 units, gets pulled at $5.50. We need this next layer of 1,000 units at $6, and that gives us 1,500 units of our 3,000. Then we need another 1,500 units out of this third layer of 3,000. So when we take 1,500 units out of that layer, there are 1,500 units left in the ending balance at $7, and the 3,000 units at $7.50 did not get touched. That leaves our ending inventory at $33,000 and our cost of goods sold column at $38,500. So you can see under the periodic, those are the same numbers. It doesn't matter whether it's periodic or perpetual. In the FIFO method, you're going to end up with the same numbers. Under LIFO, you will get different numbers, however. And LIFO assumes that the units sold are the most recent units purchased, or ending inventory then consists of units that are acquired first, or the older acquired units. We see our makeup here of what we have in ending inventory and what we have for units sold. You see our ending inventory is made up of our beginning inventory of 4,000 units plus 500 units on our January 17th purchase. Now with periodic LIFO, you're going to build your ending units or inventory by working forward from the beginning inventory and oldest purchases until you get the quantity counted in the physical inventory. So the cost of the inventory is determined to be $25,000, which we'll calculate below using this periodic system. We'll see our 4,000 beginning inventory here in illustration 87G at $5.50 unit cost equals $22,000. Then we need 500 more units from our January 17th purchase at $6 unit cost is $3,000. That adds up $25,000, making up our 4,500 units in ending inventory. When we subtract that, $25,000 from our goods available, 71,500. We ended up with our cost of goods sold at $46,500 for our 6,500 units sold. And we can calculate that directly for those 6,500 units sold as follows. You'll see we'll have 500 units at $6, 3,000 units at $7, and 3,000 units at $7.50 that make up the same 46,500 we calculated in 8.7G. Under the perpetual LIFO, which is shown in illustration 8-7H, each time inventory is purchased or sold, we have to adjust the LIFO layers. And this works just like we did before with the perpetual FIFO. And you'll see every time that we have a purchase, we have information that we have to include into the balance. And every time we have an amount sold, we have to reflect that in the balance. You'll see we build layers indicated by the bracketed amounts here in the balance column, and we end up with $44,000 cost of goods sold in our ending inventory at $27,500. Now this is different from what we did up above with the periodic LIFO, which resulted in $46,500 cost of goods sold and $25,000 in ending inventory. So in the LIFO method, your periodic and your perpetual amounts will differ. The comparison of the cost flow methods, we see the three that we just went over, the average weighted cost, the FIFO method, and the LIFO method. You'll see that in total that they're all $71,500. But the cost of goods sold, $42,250 under the weighted average, will be somewhere in between the FIFO and the LIFO, as you see, $38,500 and $46,500. And so will the ending inventory amounts. The $29,250 is somewhere in the middle here between the FIFO and the LIFO amounts of $33,000 and $25,000. Now, during periods of rising costs, as it was in our examples above, FIFO results in a lower cost of goods sold. And you'll see that FIFO is $38,500 compared to the LIFO of $46,500. If costs are declining, though, our FIFO method will have a higher cost of goods sold and lower ending inventory than the LIFO method. Now, each of those three methods we just talked about, average weighted cost, FIFO, and LIFO, are permissible according to generally accepted accounting principles and are frequently used. Now, a company need not use the same method for its entire inventory, because there may be certain types of inventory that they want to account for with a different method than what they use for the majority of their inventory. And International Paper Company is one company that does that. Because of the importance of inventories and the differential effects the methods have on financial statements, a company must identify the methods that they use in a footnote or disclosure note. Illustration 8-8 shows a survey of inventory methods used by 500 large public companies. Now, you'll note that the number of companies it shows here, 669. Well, that is because that some of the companies are using more than one method. So that's why you can see that there is a fair share that are using more than one method. But you can see that it's a lot of companies are using FIFO. And then it's kind of a very close between LIFO and average cost. Now, what factors motivate a company to choose one method over another? Well, the impact on their financial statements is an important consideration. The inventory choice determines how closely the reported costs reflect the actual physical flow of the inventory, the timing of reported income and income tax expense, and how well costs are matched with associated revenues. Well, we're going to talk first about that physical flow, the first of the three. If a company wants to choose a method that closely approximates specific identification, then the actual physical flow of the inventory in and out would be a motivation for that choice of method. But, for example, on perishable goods, such as grocery items, the FIFO method is the best mirror of the physical flow, because those items that are perishable, they need to move those out of the grocery store first rather than last, so that they don't spoil and have to be thrown away. The average cost method might be useful for chemical companies where they have to mix liquids at various different times and different prices when they acquire them. So that might be a method that works for them. The income taxes and net income. Over the entire life of the company, the cost of goods sold for all years will equal actual cost of items sold, regardless of what inventory method is used. However, in each particular year, different inventory methods can produce different results. As I said before, when prices are rising and inventory quantities are not decreasing, LIFO will produce a higher cost of goods sold and therefore lower net income than other methods. On companies' income tax returns, this lower taxable income using LIFO will lower the taxes they have to pay. Now keep in mind that those taxes are only deferred, because as I opened up in this section, over the entire life of the company, the cost of goods sold will equal actual cost of items sold regardless. So over the lifetime of the company. However, in those interim periods from year to year, there will be some taxes that are deferred under this LIFO method. And we know from Chapter 6 that in the discussion of time value of money, it's more advantageous to save $1 today, i.e. through deferral of income taxes, even if it must be paid back in the future. So this method in periods of increasing prices has motivated companies to switch to LIFO in order to gain this tax benefit. IRS has some regulations which determine IRS determines the federal taxable income. And these some regulations that they have require that if a company uses LIFO to measure taxable income, then the company must also use LIFO for external financial reporting. That's known as the LIFO conformity rule. Now, the income tax motivation for using LIFO may be offset by the desire to report higher income. However, that higher income could have an effect on a corporation's share price. If that reported net income is affecting share price, it could also affect bonuses paid to management or debt agreements with lenders. So, in other words, if you're using that LIFO method to report a higher net income, that net income figure could have impact like on the New York Stock Exchange on that company's share price. So those are some things that companies do want to take into consideration when they're picking the inventory method that they want to use. Now, the LIFO conformity rule that I talked about earlier must be reported in a disclosure note, not on the face of the income statement. And we see an inventory disclosure note in illustration 8-9. So you can take a look at that and how they discuss that in which be the first note, the significant accounting policies. Now, some companies that use LIFO for external reporting and income tax purposes, but maintain their internal records using FIFO or average cost. Now, in order to do this, they're going to have a general ledger account called a LIFO reserve account. And they're going to record in this LIFO reserve account, which is a contra account to the inventory, the amount of difference between the LIFO and the other methods that they are recording internally. So, for example here, DoubleTree Corporation began 2016 with a balance of $475,000 in its LIFO reserve account. The difference between inventory valued internally using FIFO and inventory valued for external purposes for LIFO. At the end of 2016, the difference increased to $535,000. So they're going to have to make a credit entry to that contra inventory account, LIFO reserve, for the $60,000 difference. The debit goes to the income statement on cost of goods sold, and effectively this brings the LIFO valuation externally in balance with the FIFO balance internally. And companies such as DoubleTree that we just went through that entry would use a disclosure note to show this difference between the ending inventory value used in the internal method and the LIFO inventory amount reported in the balance sheet. Books A Million has an example in illustration 8-10 that shows this LIFO reserve, how they would record it in a footnote. LIFO liquidations will happen when companies have to dip into their older layers of inventory. Now, as we've discussed before, LIFO will generally give a better match of revenue and expenses because you have the most recent selling prices in your revenue accounts matching up against your cost of goods sold, which is including your most recent purchase or acquisition costs. And proponents of this argue that it's a better match of revenues and expenses, i.e. the matching principle. Inventory costs in the balance sheet with LIFO, however, are out of date because they reflect the old purchase transactions. And even though they're getting a better match on the income statement, this appears to be a problem on the balance sheet because older costs are carried on the balance sheet. And when inventory quantities decline during a period, these out-of-date inventory layers are liquidated or dipped into, and cost of goods sold will have partially non-current costs matched up against their current selling prices. And that's what it's called, this occurrence is called a LIFO liquidation. So these paper profits caused by this out-of-date, low-cost inventory in the cost of goods sold is referred to as the effect on income of liquidations of LIFO inventory. And we see an illustration in 8-11 that reflects how this can occur. National Distributors uses the LIFO inventory method, and the company began in 2016 with inventory of 10,000 units that cost $20 a unit. During 2016, 30,000 units were purchased for $25 and 35,000 units were sold. Their cost of goods sold for 2016 includes 30,000 units at $25 and 5,000 units at $20. So there's a $5 difference there in units. So the total cost of goods sold is $850,000. Now, if the company had purchased at least 35,000 units, there would have been no liquidation, and there wouldn't have dipped into that 5,000 units at $20 a unit. And the cost of goods sold would have been $875,000 as opposed to $850,000. So this $25,000 difference is a result of a LIFO liquidation. Now, if this company is in the 40% tax rate, the net effect of this liquidation is to increase net income by $15,000, or the $25,000 difference times 1 minus the tax rate. The company must disclose in a footnote any material effect of LIFO liquidation. Example in 8-12 explains how this would be done for Genuine Parts Company. In our national distributors, we would disclose the example that we just went through for LIFO liquidation. They would disclose the LIFO liquidations increased income by $15,000, assuming that the effect on the income is considered material. So they would disclose that in a footnote. The next section is a concept review exercise, which has all the information with a different example that we've all the techniques we've already went through, so I'll bypass that. And we'll go down into inventory management. Managers closely monitor their inventory levels to ensure that the inventories that they have on hand will sustain operations, and to hold the cost of ordering and carrying inventories to the lowest possible level. In order to meet these two objectives, there are a variety of tools available to help them meet those, including computerized inventory control systems and also outsourcing of inventory component production. Because those first two objectives, ensuring that they have enough inventories on hand, while at the same time trying to hold the cost of ordering and carrying inventories to the lowest possible level, can conflict with each other. Well, a way that they can try to meet the best of both situations is a system called JIT, or just in time, where companies will try to coordinate production with suppliers so that the raw materials and components arrive just in time in need for the production process. We have some illustration here with Rite Aid in our financial reporting case, and they talk about comparing Rite Aid with a competitor that used all FIFO, or that used both LIFO and FIFO, but with different percentages. To get an apples to apples comparison, we can convert Rite Aid's numbers and cost of goods sold, inventory numbers and cost of goods sold, to 100% FIFO before comparing the two companies by using the information that was provided in illustration 8-9. And you can go through those numbers and compare them. It's just a technique to show that you can make an apples to apples comparison even though companies are using different cost flow assumptions. A couple of tools that we'll take a look at that will help us in our analysis of companies is called the gross profit ratio. And the gross profit ratio is computed by taking the gross profit divided by net sales. Now, the higher the ratio, the higher the markup a company is able to achieve on its products, because the gross profit is your sales minus your cost of goods sold. So the higher this number, that means you're getting more gross profit out of your sales. So, as it says here, the gross profit ratio indicates the percentage of each sales dollar available to cover expenses other than cost of goods sold and provide a profit. In our Rite Aid numbers that we had above, the gross profit ratio is 29.1%. The same ratio for the drugstore industry is 17%. So Rite Aid's able to sell its products at higher markups than the average of its competitors. Now, in Chapter 5, we were introduced to the inventory turnover ratio, which is designed to show how effective a company is in managing its inventory. It shows the number of times the average inventory is sold during a reporting period. The higher the ratio, the more profitable the company, because the more times it can turn its inventory into sales, it's going to be getting margin coming in from those sales and gross profit. So A declining ratio, however, is seen as unfavorable, which could indicate obsolete or slow-moving products, poor marketing conditions, and sales efforts. So our calculation for inventory turnover ratio is our cost of goods sold divided by our average inventory. An average inventory would be your beginning of year amount plus your end of year amount divided by 2. We can divide this inventory turnover ratio by 365 days to get the average number of days in inventory, which tells us how long it normally takes a company to sell its inventory. For Rite Aid, the inventory turnover ratio is 4.48, and the industry average, is 4.48 for the inventory turnover ratio, and the average days in inventory is 81 days. The industry average is 33 days compared to the 81 days. So Rite Aid's products, although they do have a higher markup, their inventory turns over much slower. And for earnings quality, the choice of which inventory method you choose can affect earnings quality, particularly in times of rapidly changing prices. As we've indicated above, as prices go up versus prices going down, it can impact your earnings depending on which cost flow assumption you're using. Now, inventory write-downs and changes in inventory methods are two techniques a company could use to manipulate earnings, and we'll discuss these issues in Chapter 9. That will conclude Part A's lecture.